Hi, it's Anthony here. Now, before we get into the video, I just want to assure you that this is the real deal. I'm not a digitally enhanced AI avatar or anything like that. It's the real me. Done some research on this, put together this presentation, and hope you enjoy it. So what we're looking at today is potentially the single largest financial threat on the horizon, what we call a $59 trillion domino. UBS has already issued a shocking warning about a hidden credit crisis that's poised to topple some of the world's biggest banks. This isn't just about one institution. It's about a systemic vulnerability that most people aren't paying attention to yet. To understand the scope of this, we have to look at the canary in the coal mine, Deutsche Bank. If you look at the graphs here, you'll see a terrifying disparity, and I don't say that lightly. The average European bank has about an 8% exposure to private credit, but Deutsche Bank exposure to this risky market is nearly a whopping 30%. This extreme level of exposure to such a risky market is causing them to be positioned as the most vulnerable financial giant in Europe and the likely first domino in a global chain reaction. So what exactly is this exposure? It's referred to as shadow banking or private credit. Simply put, these loans are made by non-bank, unregulated lenders. It's a massive, fast-growing market worth $59 trillion globally that finances everything from factory inventory to risky corporate bets. The danger lies in the fact that it operates without the oversight and safety nets of the traditional banking system. And because major banks like Deutsche are deeply entangled in this, they are reintroducing this hidden risk right back into the global financial system. This credit bubble is colliding with harsh economic reality. The world's economic engine is sputtering. We are seeing a manufacturing trend emerge that we haven't witnessed since 2008 during the financial crisis. In the Eurozone and Germany, we see contraction and a fall in new orders. Even in North America, we're seeing solid declines in output, signaling deceleration. This is the first crucial sign of weakening consumer demand on a global scale. This brings us to the charts banks don't want you to see. Look at the divergence. Factories are still producing, but customers are not buying. The gap between what is made, the dark line, and what's being ordered, the red line, is the widest it's been since 2008. As Chris Williamson from S&P Global points out in a recent report, unless demand improves, these current factory production levels are clearly unsustainable. Let's walk through exactly how this triggers a crisis. First, global new orders plummet. Okay, this leads to step 2. Inventory piles up in warehouses, all of which is financed by that private credit we talked about. As businesses can't sell products to pay back those high-interest shadow loans, credit risk spikes and delinquencies rise. Banks like Deutsche see this, panic, and they tighten lending standards. So this creates a credit squeeze, leading to layoffs and finally widespread defaults start to trigger insolvency at the most exposed banks. When banks get scared, people lose jobs. History shows us a clear and painful pattern when this happens. When banks perceive rising risk, they dramatically tighten lending standards, cutting off the flow of credit. You can see this on this chart. As the blue line of tightening standards goes up, the red line of unemployment inevitably follows. Without access to capital, businesses are forced to lay off workers. So we're seeing this tightening happen right now, meaning the next wave is rising unemployment. No job, no spending, no recovery. This creates a cycle that feeds on itself. As you can see here, as layoffs rise, the red line, consumer demand and retail sales plunge, the blue line or the dark line. This means even more inventory sits idle on the shelves, putting even more pressure on private credit loans that finance them. This is the final stage before the credit defaults begin to surge. The fuse is lit on a $59 trillion time bomb. The pieces are all in place. We have unsustainable production fueled by inflation fears, plunging consumer demand, and a massive $59 trillion credit bubble. Vulnerable institutions like Deutsche Bank are ground zero. Once they fall, they take global banks, the economy, and jobs down with them. However, the coming volatility doesn't have to be your financial ruin. In fact, every crisis creates opportunity. So with the right strategy, you can protect your capital and position yourself for massive profits. The key is understanding exactly where money will flow when the crisis hits. So here's how to position a portfolio for the storm. First, reduce exposure to tech and cyclical stocks. These are often the first to fall in a downturn. Second, look at defensive sectors like utilities and healthcare. People need these regardless of the economy. And finally, watch for entry points in gold and silver. You might want to wait for the current parabolic move to correct, then consider re-entry. Bond King, Jeffrey Gundlach, I think that's how you pronounce it, also recommends holding 20% in cash or short-term treasuries as a safe haven. But we want to go beyond just surviving. We want to thrive. In a crisis, volatility is guaranteed. We're seeing that. And our systems are designed to turn that volatility into profit. We identify when institutional trading algorithms are positioned to make significant moves, and we provide people with an edge in a turbulent market. Our system removes the guesswork by analyzing and providing actionable trade ideas in the currency markets. It gives you daily tradable signals, risk control levels, and you get my personal opinion on the best trades. It's a fully optimized and back-tested strategy designed to give you a solid advantage. I'm so confident in this system that I want you to turn this coming crisis into your greatest opportunity. Okay? We want you to try it for yourself. On me. You can see the signals, track the trades, and understand the advantage you can have in any market condition with a completely free 7 or 14-day trial, depending on the plan you prefer. So here's what you need to do. Click on the link in the description below or visit my website, anthonyfx.com, and lock in a free trial. You'll get daily trade signals, risk controls, and regular market updates to make sure you are on the right side of the coming market moves. And I'm going to be heavily focusing on gold in 2026. If you found the information in the video helpful in any way, or not helpful if that's the case, comment below. Let me know your thoughts. A thumbs up would be greatly appreciated. That would help my channel. Hit the bell to be notified as I'm going to be uploading regular videos. And with that, I hope you have a fantastic day, and I'll see you in the next one.